Today, we will talk about the Basel Accords. The Basel Accords are a series of 3 sequential banking regulation agreements set by the Basel Committee on Bank Supervision. The committee provides recommendations on banking and financial regulations, specifically, concerning capital risk, market risk, and operational risk. The accords ensure that financial institutions have enough capital on account to absorb unexpected losses. The Basel Accords were developed over several years beginning in the 1980s. The BCBS was founded as a forum for regular cooperation between its member countries on banking supervisory matters. The Basel I Accord was originally organized by central bankers from the G10 countries, who were at that time working toward building new international financial structures. The meetings are named Basel Accords since the BCBS is headquartered in the offices of the Bank for International Settlements located in Basel, Switzerland. Member countries include Australia, Argentina, Belgium, Canada, Brazil, China, France, and more. The first Basel Accord, known as Basel I, was issued in 1988 and focused on the capital adequacy of financial institutions. Under Basel I, banks that operate internationally must maintain capital equal to at least 8% of their risk-weighted assets. For example, if a bank has risk-weighted assets of $100 million, it is required to maintain capital of at least $8 million. The second Basel Accord, called Basel II, served as an update of the original accord. It focused on 3 main areas: minimum capital requirements, supervisory review of an institution's capital adequacy, and the effective use of disclosure as a lever to strengthen market discipline and sound banking practices. Basel II also introduced 3 tiers of eligible regulatory capital for banks. In the wake of the Lehman Brothers collapse of 2008, the BCBS decided to update and strengthen the accords, leading to Basel III. Basel III is a continuation of the 3 pillars of Basel II, with additional requirements and safeguards. The final Basel III framework includes phase-in provisions for the output floor, which will start at 50% and be fully phased in at the 72.5% level from January 2028. Here are 3 key takeaways. 1. The Basel Accords refer to a series of 3 international banking regulatory meetings that established capital requirements and risk measurements for global banks. 2. The accords are designed to ensure that financial institutions maintain enough capital on account to meet their obligations and also absorb unexpected losses. 3. The latest accord, Basel III, was agreed upon in November 2010. Basel III requires banks to have a minimum amount of common equity and a minimum liquidity ratio. Hope this would help. Thanks for watching.